Hi, welcome to SOFA. My name is Shadakokoko Frempong, and we'll be looking at the introduction to accounting. So we'll start by defining what accounting is. So accounting is the process of recording, classifying, summarizing, analyzing, and interpreting of what business transaction or economic event in monetary terms. So this is a process, so it has to follow each other. You start by recording, classifying, summarizing, and interpreting of business transaction. So when it comes to recording, we are looking at the systematic documentation of business transaction, and we are doing this anytime they occur or they transpire. So these transactions include sales transaction, purchases, payments, receipts, and any other financial activities. And the recording process typically involves entering this transaction into our journals or electronic accounting system. So what we are saying is anytime a financial transaction transpires or occurs, we go ahead to enter it in our books or in our accounting system. So the second process is classifying. Now in the process of recording the transaction, they need to be categorized or classified based on their nature or by their type. And these steps involve assigning transactions to a specific account, such as assets, liability, equity, revenue, and expenses. So the purpose of classification is to ensure that transactions are properly organized and grouped for further analysis and reporting. Imagine telling your subordinate or your accountant to give you a summary of your sales transaction. Then the accountant tells you that he cannot classify all the transaction that has been recorded based on the expense type or nature. So he comes to you and brings all the expenses that has transpired. Obviously, you wouldn't be able to make your financial decision out of it. So what it means is all these expenditures or all these transactions needs to be classified properly. The next stage is summary. So once the transactions has been recorded and classified, they has to be summarized in order to create a financial report or statement. So just as the example I gave, you are requesting for a summary. You don't need all the transactions. You just need some of them, or you just need a highlight to make your financial decision. And that is going to be possible after the transaction has been recorded and categorized. Then you go ahead to make your summary out of the transaction that has been recorded and that has been categorized. Now this involves aggregating similar transactions and compiling them into a concise summary, such as the balance sheet, income statement, and also the cash flow statement. In fact, so what actually happened is that we summarize it into what we call the trial balance. And now the trial balance is what is used to prepare the financial statement. Then we move to the analysis. So analysis involves examining the financial data to identify trends, patterns, and relationships that can provide insight into the company's financial health and performance. And this involves comparing financial data to historical data or even against industry benchmark or even your competitor who is doing very, very well in the industry. So we analyze the financial statement or the financial data to help stakeholders to understand the underlying factors that is driving the financial results so that they can be able to make meaningful decisions. Then after we have analyzed, we now have to interpret. So this involves drawing of conclusion and making judgments based on the analysis of the financial data that has been done. So it requires understanding the implication of the financial information and communicating findings to stakeholders in a meaningful way. So we understand the fact that some of the stakeholders may not have an accounting background or may not be finance guys. So after preparing the financial statements and you present it to them, they may not be able to understand what has been done. So it is up to you to analyze one and interpret the analysis to them. That okay, if you are seeing gross profit margin, this is what it means. If you are seeing net profit margin, this is what it means. And this will help them to make a better decision. Now, what is the aim of accounting? It's to help us keep systematic record. It's to help ascertain operational profit or loss. Of course, if you don't keep records, you may not be able to determine your profit or your loss. Accounting also helps us to make rational decisions. If you don't have data, you cannot make decisions. In fact, in the world in which we find ourselves now, data is everything. The fourth reason is that accounting helps to provide information on our company's financial position. So, with the help of accounting, we're able to tell what are our assets, what are our liabilities, what are our equity as at a particular date. Now, let's look at the basis of accounting. Basis of accounting simply means the methodology under which revenue or an expense is recognized in the financial statements of a business. So when it comes to the basis of accounting, the very first one we have is the cash basis. So under the cash basis of accounting, we say that revenue is recognized when cash has been received, and expense is also recognized when cash has been paid. And this is mostly used by small businesses. Now what it means is that if you go what it means is if you buy goods from someone and you don't pay the person, then the person does not record the transaction, right? If you also make sales to someone and the person doesn't pay you, you also don't record the transaction. So example, you have a supermarket, then a friend comes to you and a friend buys from you on credit. Because you have not received money from your friend, you are not going to recognize the transaction that has transpired. That is under the cash basis. But when it comes to the accrual basis is saying that listen, revenue should be recognized when it is earned, and expenses should also be recognized when the benefit to that particular expenditure has been consumed. So revenue is recognized when it is earned means that the moment you are entitled to the revenue, you have all the permission and all the right to record it in your books. If the person is not going to pay it now, that is fine. But the moment the transaction has transpired or the transaction has occurred, then it qualifies to be recognized in your books. Now, so the same example, you have a supermarket, a friend comes to you, the friend buys from you on credit. The moment the transaction has transpired, you are entitled to the revenue. You have earned the revenue, just that you have not received the revenue. Under the accrual basis of accounting, you are going to recognize the transaction in your books. The same thing happens to expenses. If you are owing your landlord, even though you have not paid, you should recognize it in your books that there is an expenses of this amount. Now let's look at the components of financial statement. So anytime we talk about financial statement, people just feel it's just one statement, but the financial statement is made up of the income statement, the changes in equity, the balance sheet, which other people call the statement of financial position, the cash flow statement, and the note to the financial statement. We will look at this in detail in some other video. So anytime you prepare a financial statement as an accountant, the financial statement is expected to have some characteristics, or let me say some traits, which are not financial. So we call the qualitative characteristics of a financial statement. And the very first one is understandability. So what we are saying is that the information contained in your financial statement should be easily and readily understandable by users. You as the accountant, you are preparing your financial statement for some people, and it is important that the report or the financial statement that you have prepared is easily understood by those people. If it is not easily understood by those people, then there is probably an issue with your report. Now, it gets tricky because you are the accountant. Now, your stakeholders may not necessarily have an accounting background, so that is fine. So then that is where you have to analyze and interpret it to your stakeholders. But the key focus here is that if another accountant is to pick your financial statement, he should be able to read it and even explain it to other people. So if your financial statement is not easily understood by other accountants, then there is actually an issue with your financial statement. The second one has to do with relevance. So with relevance, we are saying that the information contained in the financial statement should be relevant to stakeholders when they are making their economic decision. So anytime you're preparing your financial statement, you should have different stakeholders in mind, because a lot of people or different stakeholders are actually going to pick your financial statement, read them, and make meaning out of it. Now, if they look at the financial statement and the information contained in the financial statement, it's not relevant to them, then it is as useless as any other thing. So what we are saying is that anytime you prepare your financial statement, make sure it has some relevant information in there for your stakeholders. The third one has to do with reliability. Now with reliability, we are looking at material error. So the focus here is that the financial statement or information contained in the financial statement should be reliable. You don't want a situation where we pick your financial statement and it's made up of a lot of errors. In fact, a lot of material errors. Of course, you're a human being. If you prepare your report and there is an error of, let's say, $1, it's fine. But like $1 million, $5,000, that's material, right? It may not be useful to your stakeholders, right? And if you prepare a financial statement or if you prepare your report and the information is full of errors, then it is no longer needed or important. The next one has to do with comparability. With comparability, we are saying that the way you prepare a financial statement, you should be able to compare the financial statement over time, meaning we should be able to compare your current year's performance against your previous year's performance. And also, if possible, you should be able to compare your performance against that of your competitor or other entities, probably in the same industry, right? So anytime you pick a financial statement, you would always see the current year and you will see the prior year beside it. It is because of what? Comparability. The next one has to do with timeliness. And you know, the timing of an information or a report is really, really important. If it takes long for you to deliver your report as an accountant, then the report may no longer be useful to your stakeholders. Some of the information that is being made by our stakeholders are really, really time sensitive, and they would need a financial statement on time to make their decision. So if there is too much delay in preparing the financial statement, then it would not be useful to them. The last one has to do with verifiability. So with verifiability, we are saying that the information contained in the financial report should faithfully represent its economic phenomena. So basically what it means is that if we bring a different, knowledgeable and an independent observer, he should be able to look at your financial statement and reach a conclusion that says that, oh, all things being equal, these financial statements actually reflect the true picture or what is actually happening in the organization. If an external person comes and the person is saying that what is happening on grounds is different from what is on the financial statement, then your financial statement actually lacks what? Verifiability. Now let's look at some limitations of the financial statement. And the very first one is that they are based on historical information, and that's true. In the sense that anytime you go out to spend, you bring your receipt, the accountant enters it in the accounting system, and the accountant prepares the financial statement with it. So what it means is that all the information in the financial statement are historical or transaction that has already transpired. So two, it involves making subjective judgment and estimate. As an accountant, there are some estimates that we make because you get to a point you may not be able to get the actual figures, so you have to make an estimate. An example has to do with depreciation. You have to estimate the useful life of the asset and use that estimated useful life to compute your depreciation. 3. Accounting concepts and standards have impact on figures used in the financial statement. And this is very, very true. There is a standard called IES2 which talks about inventory, and it says that inventory should be measured at lower of cost or net realizable value. What it means is that if the cost of the inventory is, let's say, $2,000, right, and the net realizable value is, let's say, $1,000, even though it costs $2,000 to the organization, the accounting standard is saying use this. So that's the downside, right? Even though there might be disclosure in the financial statement, and some of the figures may not really show what is supposed to be showing. The fourth one has to do with that information provided may be legal requirements by legislature or accounting standard. Then the fifth one will be that they provide only financial data about the business. Of course, it is called financial statement. So if you need any other information rather than the financials, and then the financial statement may not be of good help. So thank you for your time, and if you have any question, just drop it in the comment section. Make sure you subscribe so that anytime I drop another video, you get the notification, and also like this particular video. Thank you, and see you in some other video. Have a nice day.